According to one report, which covered a period of 10 years and covered 347 cases of fraud at public companies, there was a total cumulative misstatement or misappropriation of almost $120 billion for the 300 cases that had information available. That means almost $400 million of fraud per case. Now, the average period of fraud was over 31 months, and the most common fraud was improper revenue recognition, with over 60% of cases having that type of fraud. The second most common fraud scheme was the overstatement of assets or the capitalization of expenses. 26% of the companies in this study changed auditors between the last clean financial statements and the fraudulent financial statements. Of course, we hear about the worst examples of financial statement fraud, but remember, we only hear about them if the companies get caught. Most companies that engage in fraud never get caught manipulating their financial statements, partly because their manipulation may be relatively small, and partly because it's so difficult to detect the fraud by an outsider. There are a number of benefits of financial statement fraud, both to the company and to management. The most obvious benefit is an increase in the share prices. More profitable companies have higher stock prices because the companies are more attractive to investors. The company might also have improved debt ratings, which may give them an ability to refinance debt and to reduce their interest expense, and may give them fewer debt covenant restrictions. Management may also receive profit-based bonuses, and there may be a greater value to their stock options.